Earnings do miss, revenues beat, first quarter profit down 42, driven by increased costs tied to bad loans and market upheaval caused by the war in Ukraine. Jamie Dimon strikes a note of caution in his remarks, says, quote, "We remain optimistic on the economy, at least for the short term. Consumer and business balance sheets as well as consumer spending remain at healthy levels, but see significant geopolitical and economic challenges ahead due to high inflation, supply chain issues, and the war in Ukraine." Jim, you've been framing it as the credit reserves on one hand, the buyback on the other.
Yeah, I mean, look, there's no doubt about it. When he buys back $30 billion, he believes. And that's long term. He's not going to buy it short term. But when you look at it, you say, oh, my God, he was on the wrong end of the nickel trade. Holy cow, he's building reserves, $900 million. I thought that we weren't going to do that if the consumer's that strong and the 5% loans. So, David, I put it to you.
Put it to me? Well tell me.
I'm right. You're my partner.
Yes, I am. Always.
All right, Carl, I put it to you. No, come on. Everything was pretty good, especially, by the way, equities, which really shocked me. But he's talking his own stock down by talking about the
challenges in the broader economy
overall. Gloom and doom.
But he does that. I mean, listen, one of the things we appreciate about Jamie Dimon is you do seem to get it fairly straight from him. And so there is that. The stock has never recovered from the last quarterly earnings, where there was a lot of concern about expense. That is not going to be the case here, I don't believe, Jim, in terms of additional expense or expense coming in way above where the estimates have been. Obviously, a lot of that had already been reflected in perhaps estimates. And again, the stock price never fully recovering. They did add to loan loss provisions in a fairly significant way, perhaps as well, reflective of what Mr. Dimon is talking about on the call in terms of concerns about the overall economy.
But remember, what drove it down last time was he had to increase his spend on technology. This time, not really a focus. But if you think, this is, the way I would play it. Let's say I am a CEO of another bank. Well, I will be sure not to mention the long term. Because if you want your stock down, you just say, hey, listen, I'm worried about, he didn't mention Zelensky by name. He didn't talk about the lockdown in China. But I read that and I said, boy, is he worried about Ukraine? Oh, man, he's scared about China. And I didn't want to hear that. Because those things could get better or worse. They don't have to necessarily both get worse.
Right. Certainly, the reserve buildup is a change directionally from recent quarters. As Jim mentioned, trading was a beat. Investment banking, though, a bit of a miss.
Yes.
Mortgage demand is going to be a worry as affordability takes a hit. I don't know if you saw mortgage apps, but we got mortgage origination, the Bankers Association says, will probably be down by a third this year.
Yeah, and the refinance is awful. Really awful, down 60%.
Down 60.
Now, I thought bright side was it decreased only 1.3% week to week, given the fact how fast rates are going up. But I find it quizzical that you can say that you should increase your loan loss reserves and at the same time say the consumer is very strong. But then I worry, and I think, David, did you know they were on the other side of the nickel trade?
No, I didn't.
Can you elaborate?
No, I wasn't aware of that. And so we can take that into account.
Who was on the nickel? Do you remember?